Hello there, everybody. Welcome to our session this evening. My name is Karen Beckham, and I will be presenting to you Dream Retirement, Build It in Your 50s. So hopefully you're all excited to listen to what we have to say today. Obviously, we want to help you get your retirement settled. So, first of all, I'm just going to go through what we're going to cover this evening. We're going to go through how we adjust your financial strategy in your 50s, very important, yes. We're going to talk about mortgages, investments, how to stay on track. We'll talk about the essential pre-retirement considerations and conversations that we all need to be having. And we will be bringing an amazing panel with Carla and Stuart from AdviceFirst. He's one of our senior wealth managers, and we'll have a bit of a Q&A towards the end of the session. So we'll get started. So first of all, very important to let you know that tonight's presentation is for information purposes only. It's not, the content is not to be used for personalised advice. There's no substitution for sitting down and speaking to a real expert, a real financial advisor. So for myself, Stuart and Carla, the information is for information only. So I want to just tell you a little about myself. My name's Karen. I'm a financial advisor, strategist and coach here at Enable Me. My job, I absolutely love it. My job is to help give financial advice and confidence to my clients, to help people get ahead and do better, to save faster and save more, to get in control of your money, to get you ready for retirement, and to help grow wealth. So a bit about me personally, because, you know, obviously this is talking about us being prepared for retirement in our 50s, getting ready to get into that sort of next stage of life. So I'm 57 years old. My husband Mark is 56. So, you know, for us, we are actually in this stage of our life. So we're constantly reviewing our plans, making sure that we're on track, adjusting, and really importantly, still enjoying a really, really great life before retirement, because we don't want to put everything into retirement and not enjoy the life we're living at the moment now. So between Mark and I, we've been through all of the things that you can think of in the last probably couple of years. We've had restructures at work, we've right-sized our house, we've become empty nesters. So the presentation that I'm giving to you is really personal to me, because it's actually what I'm going through at the moment, and possibly what a lot of you may be going through or thinking about at the moment. So I'm hoping that this evening I'm going to be able to provide you some good information and ideas about how you can prepare yourself financially for your retirement. So my background, I spent about 40 years working in banking. So I managed branches. I was a premium banking centre manager, and I left that sort of space because I was a bit not so happy with the way things were going, with the big profits being made. And I am really happy to be working here at Enable Me as a financial advisor coach. We can really help people get ahead for their finances, for retirement, buying houses, etc. So in your 50s, it's really important to obviously revisit your financial plan and your goals to ensure you're on track. That as long as you've got a financial plan, so hopefully all you do, and if you don't, you know who to come and ask about one. But there can be some distractions. So things like health, family, and what your ideal retirement is going to look like. So there's a few key considerations that we've got to think about, ensuring that we've got enough money for our own retirement, and then looking to see whether or not we can help family or leave a legacy for later. So, you know, there's a lot of things that start to happen in our 50s. You know, as I said, we become empty nesters, we might become grandparents, we might have lost our parents, family and friends. All of these changes to careers, health and things like that really has big impacts on what we do in our 50s and moving forward, making sure that we're continuing to focus on getting that retirement sorted out. So we sort of need to think about things like, what will retirement actually look like? What kind of income do we need? What kind of lifestyle we want to have? Do we want to travel? Do we want hobbies? Do we want to have choices about when we actually finish work, or whether we work part-time? So these are things we have to start talking about. And if there is an age difference between you and your partner. So my husband's a year younger than me. So we were talking about this the other night, and I said, he laughs and says, oh, I'm much older than him. And I'm like, yeah, but that means I get to retire a year younger than you or a year before you. And he's like, no, we're retiring together. I'm like, well, either one of us is retiring early or one of us is going to stay on working for a bit longer. So not my intention to do it, but you never know, do you? So that's really important. So in our 50s, we've got to sort of ramp up everything that we're doing. So we have to look at our lifestyle planning. We need to make sure that our children are financially independent, because a lot of people still have children that are dependent on them in their 50s. We've got to look at our estate planning. We've got to think about the options of doing things like using our properties to leverage to buy investment properties, because we sort of get into that stage where the banks won't lend us too much for too much longer. And also if there's some changes to our career. Now that could be changes that we decide on or changes that are made for us. So these are things that sort of happen in our 50s that we've got to be able to pivot around, but really ramp up and save as much as we can and build as much wealth as we can so we can have those great retirements that we want. There are some hurdles, so we've got to be careful of our hurdles that could stop our progress. So they're things like relationship breaks down. When we have those big changes in our lives, like kids leaving home, sometimes relationship breakdowns happen because of that stage of our lives. We're still supporting adult children. There's a lot of adults supporting their adult children in retirement. We might start to have health issues in our 50s, so we need to be more aware of looking after ourselves. We might still have significant mortgage debt, which obviously before we get into retirement we want to get rid of. And again, as I say, to those redundancies and restructures, which are quite common at the moment. So they are things that could prevent us from actually moving ahead at pace. But the good news is we still have between 5 to 15 years of runway to grow our wealth before we hit retirement. So the aim is obviously to ramp up our progress as much as we possibly can in the next, 15 odd years. And as I've said, if we're not mortgage free now, we need to really focus on getting mortgage free. Owning your own home in retirement is fantastic. It already comes with additional costs of maintenance, insurances and rates and that, so we do not need the added burden of a mortgage. So obviously getting mortgage free in our 50s, there's a few benefits to that. Obviously it reduces our expenses in retirement, it reduces the amount of interest, and also the last opportunity to leverage towards investment properties before retirement. So we'll talk a little bit more about leveraging in the future, but obviously the lower your mortgage is, or the less, if you have no mortgage, you then have the ability to leverage. So repaying your mortgage unlocks options for growing our wealth and retirement. So obviously in our 20s, we're starting out. In our 30s, we're building up. So the average first home buyer in New Zealand at the moment is 36. So that's in the middle of those 30s. In our 40s, we're paying off mortgage, growing wealth. Our 50s, we're really ramping up the growing our wealth. And then our 60s and 70s and 80s and 90s, we are going to be sitting back and reaping what we've grown. So when we're looking at our fundamentals, we really need to re-look at our fundamentals to make sure that we're reducing fritter and freeing up as much extra cash as we can. So for that, what we need to do is we need to understand our tendencies. We need to have a strong money mindset. So that's making sure that we understand what we need to do to make forward progress. We have to have good financial habits, so making sure that they've been embedded and that we continue and always continue to build on those. And often when we get mortgage free, our good financial habits can waver slightly. So we need to keep focused there. We need to be aware of all of those short-term debts that are easy to get, like the credit cards, the afterpays, all of those bits and pieces that come through that, particularly like recently, the Black Friday sale, suddenly there's stuff that you don't want to buy that you're thinking about buying. We need to make sure we've got emergency funds. We need a buffer to make sure that if there's something that goes wrong, we've got some money just to back us up. We also need to make sure our wills and our insurances are all up to date because they're part of our foundations to make sure that we can progress. And we need to make sure that our KiwiSavers are working really well to provide extra money when we go into retirement. So making sure that we're in the right fund with the right provider to maximise our returns. So when I talked about the tendencies, our money tendencies, these are things that you've got to think about where you are at. And sometimes people see each other differently. So when we look at our money personalities, we have our shoppers. So our shoppers are they quite enjoy spending money. They're quite energized by spending money, and sometimes they can get buyer's remorse later on. Our savers like to see their balances grow, so they're very motivated by seeing that balance in their bank account grow and grow and grow. And then we have what we call our plotters, and our plotters sit in between a shopper and a saver, and they're able to save when they want to and they can shop when they want to. So they're a bit more of a even money personality type. And as we go through life, sometimes our money personality changes, particularly as we're getting rid of getting closer to retirement, because we just have to be more conscious of where we're spending our money, because we know that that money or that pot of money won't last us a huge length of time. So we've got to make sure that we enjoy life, but we're not being wasteful or, frittering our money away. The other side of the things that we look at is our cash position. So our cash position is how we feel about our financial situation at the moment. So we've got the three options. One is sinking, where we really aren't getting ahead at all. We're actually going backwards. Floating, where we actually can afford to pay our bills. We have, not too many worries about money, but we don't feel like we're getting ahead at great pace. And we've got flying, where we don't have too much of a money worry, but we don't necessarily know where we're going unless we have a really good plan. So those are our money tendencies and our cash positions. Often when I sit down with couples and I ask them what they think their cash position is, sometimes they can feel differently about their cash position. So we do have to be really careful that things don't get derailed by events that happen in life. So things like supporting our adult children, the lifestyle creep that can happen in upsizing. So as we get mortgage free or our debts get lower, we get maybe a bit of an increase in our salaries. We don't have the children at home, so we have a bit more money to spend. That lifestyle creep can come in, and that means that we start to spend a bit more and a bit more, a bit more. So we have less money put aside to do the things that we should really be doing, which is investing and growing our wealth for the future. Health issues is a big thing when we hit our 50s, and it's not always us, it can actually be our friends or family. So if you have family or friends that get particularly get quite sick or even pass away in our 50s, it's really easy to sort of think, oh, stuff it, like if my friend didn't make it past her 55th birthday, why try putting everything off, to retirement? Why not do it now? But that doesn't mean those things are going to happen to us. So we have to really keep on track and make sure that we are enjoying today, but making sure that we're planning for the future. And of course, those career changes at the moment are a bit more frequent and happening more often out there at the moment. So those are some of the things that can derail us. So it's really important to have a good plan to help us navigate all of those potholes that can happen. So we do need to adjust our strategy when we're heading towards retirement. In our 50s, it's really essential that we have the right financial plan in place and the right strategy in place. If you don't have a financial plan or strategy, it's really important you sit down with a financial advisor and put something in place. But our experience says, especially when people try to do things on their own and there's health issues, you can drastically alter what happens next in life if you don't keep focused. So the right plan incorporates freedom and enjoyment for now, while creating and protecting your financial future for security for the future. So it's really important that we have a good life now, but we're planning to have a good life going forward. So it's not just going to come to a screaming halt when we turn 65. So The funniest thing that we have to sort of cope with is all our lives we've been accumulating assets. So we're, watching our KiwiSavers going up. We're hopefully got some money outside of KiwiSaver and that's growing on wealth as well, maybe some investment properties and things like that. But we need to start to think about decumulating some of those assets as we're starting to head towards retirement. And it doesn't mean that when we turn 65, all of those funds are going to be cashed in or their investment properties are going to be sold, because they're still going to be needed to sort of help us through retirement. Retirement, for most people, is a reasonably long length of time. So we want to make sure that the funds are still growing or the investment properties are still growing, but we need to have a good phased approach to having funds available for us when we retire. And it might mean changing some of our asset classes around or our KiwiSaver strategy that we're in. So we don't want to put all our eggs in one basket. That's really important. And the biggest basket we don't want to put everything into is our KiwiSaver. And the reason for that is KiwiSaver is fantastic. It is awesome. And I would say to everyone, if you're working, you get your 3% from your employer, you're putting in your 3%. It's like having a 3% pay increase from your employer, and that will grow in the background. But there are some limitations about when you can and how you can take your money out of your KiwiSaver. So invest in your KiwiSaver, put your 3%, the minimum amount in, your employer's putting that amount in. If your employer puts more than 3% in, then match what they're doing. But it's really important to also look at investing slightly outside of KiwiSaver if you want to have the options of being able to retire earlier, or if you need the money for other things, because KiwiSaver is restricted about how you can withdraw your money. It's really important that you review your KiwiSaver to make sure that you're in the right risk profile for your age and time frame and horizon. So that's really important, and making sure that you're reviewing regularly your current provider and how those funds are performing. So that's very important to do. So if you want to save more money than you're putting into KiwiSaver, there are other options available to you. So one might be managed funds. Managed funds are very similar to KiwiSaver, but they don't have the restrictions on withdrawals as KiwiSaver does. So as I say, it's very similar. It's quite a liquid investment, meaning that you can take your money out with only a few days' notice. It allows you to invest in a diversified fund, lots of different types of asset classes. It isn't quite as volatile as investing directly in the share market because you are quite diversified. So it actually offers quite a few different investment styles, options, and risk levels. So it's something that will suit most people. We have professional fund managers that look after those, but you do need to be aware that managed funds do charge fees. There still is volatility depending on the type of fund that you're in, and you need to make sure that you're making really good informed choices based on your circumstances. So again, speaking to a wealth manager or a financial advisor is where you need to go for that. Property. Property is a really great way to grow wealth. It's quite reliable. You can obviously invest in property for long periods of time, and that's where we use the power of leverage to buy investment properties. It's one of New Zealand's most favourite investment. Lots of property investors out there probably. It's quite stable, it's reliable, it offers a good yield, consistent, measurable growth. It's tangible, so you can actually go and see it, and you can use leverage towards buying it. So you've got to make sure you have the right property, because not every property makes a good investment property. So looking for those growth, the yield, the right property. Don't want anything that's too old. You don't want to have to do a lot of work on it. You need a good wealth manager, a good property manager and accountant, all the right people there to actually help you with those investment properties. Right. So when we're looking at making a long-term financial plan, that includes all the right mix of investments for you, and that can be different for different people. So it's really important that you diversify and have a good mix of investments, and that helps you reduce risk. So, defining a legacy. So, for a lot of people, leaving a legacy to family, friends, it could be the SPCA, is really important. So, it's really important to think about what you want to achieve. Is it retirement savings for yourself plus a legacy for family and friends and possibly charities? So there are some really essential things that you need to think about when it comes to estate planning. That's making sure you've got an up-to-date will, that you've got a power of attorney. There's two types of power of attorneys. There's one for property and personal care and welfare. You've got to also think about rest home subsidies and whether or not a trust might be something worthwhile for you to look at. It's really important to make sure that you and your partner have good, honest, open discussions about retirement and what your retirement goals are. So make sure that your ideas are aligned with your partner. If you are in a second relationship, it's really important that you also think about if you've had children from previous relationships, making sure that you're protecting them and you understand. You explain to your partner what it is that you would like to happen should something happen to you. Again, understanding what our goals are. So if there is a difference in our age, it's also a matter of, like when will we both retire? Will it be together or will one retire first and the other person continues working full-time, part-time, whatever it is? So it's really important that you have those discussions. And by having those discussions, it avoids problems in the future. So leaving a legacy for family, friends, charity, whatever it might be. So my personal belief is that you should take care of yourself first and not sacrifice your retirement to leave your children with huge legacy or inheritance. That's just my personal feeling. We work hard. We want to have a nice retirement. If we're in the position that we can leave something for our children, that's absolutely fantastic. Some people feel the opposite, and that's fine. Either sentiment is valid and it's up to you what you want to do. But the real beauty of having a great financial plan is that you actually don't have to choose. You can actually have both. So what you've got to do is obviously decide what you'd like to do. Make sure that you've got your wills up to date, that your spouse or your partner understands what you're wanting to do. Communicate with your beneficiaries about what you'd like to do. If you are in a second relationship, as I say, and you've had children from a previous relationship, make sure that your will is up to date and reflects the fact that you do or don't want to leave your money to your children, because you can quite easily disinherit your children, which is probably not a nice thing to do. So the legacy is really important. The other things to think about is if you are buying into a retirement village, remembering that you don't actually buy the property necessarily that you move into. It's a right to occupy. And those properties can actually become quite expensive. So please make sure if you are looking at moving into a retirement village of any kind, you get some really good legal advice there. The other thing when it comes to leaving legacies, you've got to understand if you have got money and you think that you want to leave it to your children or to the SPCA or whatever, if you end up going into care, it can cost quite a bit of money. I think it's about $1,700 per day. And if you don't get the care subsidy, so your money will whittle away by the care costs. So just be aware of that. So make sure that your all that planning is put in place before you can't put it in place yourself. So the best approach for you depends on things like your time frame, your goals, your risk appetite, your capacity for risk, so whether or not you can borrow money if you're wanting to leverage, your cash flow requirements, so how much do you actually need, your flexibility, your ability to access mortgage lending. That may mean that the banks or the Reserve Bank can change things. You can't always access lending, and your wealth and your retirement goals. So that's my part of the presentation. So I would like to introduce Carla and Stuart. So Carla and Stuart, are you there?
We are indeed, Karen. Thank you very
Excellent.
much. So, look, thanks to everyone who's taken the opportunity to join us this evening. Obviously, we've already covered a whole lot of material, and that might have seemed quite a bit. But it's a really good opportunity for us to actually cover some of your questions. So, I'm just going to ask our producer to just take off that Q&A panel slide so we can all come up and you can see all of our beautiful faces as we start to answer some of your questions. So look, Karen, do you want to stop sharing your screen and we will be able to get rid of that panel slide? You're right.
Doesn't seem to want to go.
Oh,
Sorry
that's
about
all good.
that.
That's all good.
Is it gone now?
No, not quite, but that's okay. We will get there. Um, what I was going to say is that there are a lot of really good questions that have come through. And so, what I'm going to do is just start by sort of saying, obviously, we've covered a lot there, and there's a lot of questions around in this period of your 50s. Is it too late to start preparing for retirement if you haven't thought about it yet? Is it is it too late to sort of start thinking about where to from here? Karen, like if someone hasn't put in place a plan yet and they come to you with 10 to 15 years left on their retirement journey, is there still time for you to be able to kind of put something in place for them?
Absolutely, yeah, absolutely. Often people think that they've left it too late. If you're in your 50s, whether you're my age, 57, there's still a lot we can do to prepare for retirement. So having a good plan means thinking about what you're wanting to achieve and the different strategies we can do or put in place to help you get there. We haven't left it too long when it comes to doing things like leveraging because the banks will still lend us money if we're buying investment properties. So no, we absolutely haven't left it too late.
And
Never,
and
ever too late.
No, and that's and Stuart, obviously a lot of us at that stage still have probably our KiwiSaver in play and things like that. And there's still opportunities to make sure that your KiwiSaver's in the right fund. And a lot of people think KiwiSaver like it finishes at 65, but that's actually not the case because although you might not be employed, doesn't mean that that KiwiSaver isn't still working for you. So there's still a lot of thought processes that someone at 50 can kind of look to go through to kind of optimize where they're at. And that's something that you would do with clients on a regular basis. Is that right, Stu?
That's true. We do that on a regular basis. Most of my clients are already in retirement. They've had their Kiwi savers, and some of them still got their Kiwi savers. One of the things that people think is that when they get to 65, they have to be in a conservative fund. That's not the case. You've probably got 20, 25 good years of living left, so you're still a long-term investor. So there's plenty of options there with KiwiSaver to keep it into a relatively balanced fund, even for right up
Yeah.
into your late 70s, and there's lots of options.
Yeah, and I think that's a really great point because I think, guess what I want you to kind of take away from there is that don't think at 50 that you've got 15 years worth of investing in preparation left. The reality is that at 65, we're kind of working on projections. Am I right? Is it to 90 that most of you guys work your projections to? So
Yeah.
that in essence is my maths is never as good as yours, but that's another 25 years. So we're kind of talking about, 25, 30, like 40, like it's actually a 40-year window that we're actually talking. And that is a huge amount of time for that money to do its work. So at 50, if there's one message we can give to everybody that's on the call here today, you, it's not too late. The preference is if you can start at 20, my goodness, the time is great, but there is still plenty of time. So if you take one thing out of tonight, which is that there's still plenty of time to do something, and the best time to do something about that is right now. Another kind of question that's come through is like, you both will see this, and it's the challenge of your challenges in your 40s are very different from your 50s. So, if you're really lucky, you are starting to kind of get into the more enjoyable phase of life. Karen, 50 is fast approaching for me, and I'm hoping that the responsibility of kids and all of those sorts of things will start to be
Yeah.
out of the way. But
Yeah.
The statistics would tell me slightly differently because a lot of us are still supporting these, I refer to them as underlings and all the rest of it. But how do you balance that kind of that pressure of saving you for your retirement, but also kind of still enjoying life? Because I think we start to think about as we get into our 50s that it's kind of going into a starvation mode to kind of get us in that last stretch. And we also don't know that like tomorrow's promised. So you kind of mentioned it. Like, how do you kind of go through that balancing act of ensuring that you're on the right path, but you're also still making the most of those holidays and things along the way?
I think if you've got a really good plan, Carla, it means it includes things that you enjoy doing in life.
Yeah,
As we said, we don't want this austere kind of plan where you have got no joy in life until you retire. We don't want to do that. So our plan would include things like holidays, replacing your car, spending time with family, spending time with grandchildren if you've got them. All of those things get built into a plan so that you know that you can afford to do these things. Yes, there might be a little bit of a budget, but that's just thinking about how much money you've got to spend. And then you can do that all the way through retirement. It's not about now, just now, it is from now and into
yeah,
retirement. So the plan allows for those things, and that's the really important part. It gives you permission to spend your money on these things because you can see what the outcome's going to be if you stick to your plan.
yeah.
You're going to be fine, you'll be mortgage free, you'll have a nice pot of money, and that will last you. And you can still do the holidays and things.
And Stuart, you've also got some people who are in retirement, and I guess it's like, how do you go through that process of being okay to spend that money? The plan still becomes really important, I take it, to kind of enjoy and know what you can spend and what you can't do. Is that right?
Yeah, that's true. And sometimes I find it really hard to get some clients to spend some money because they're so used to being very disciplined with their money and saving, 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 but finding it hard to spend it. They've
Yeah,
got way more assets than they probably need, but they're just used. It's a lifetime habit, isn't it?
yeah,
Saving and being good with your money. So there's nothing wrong with that. But eventually, what we do is do some projections. So just show them that if you what you're drawing now, you're still going to have a lot left at 90, and so
yeah,
you can afford to go on a holiday if you want, or cruise up the Rhine. So there's
yeah.
nothing wrong with that.
And I know that like even at my age, like I find that really helpful, just knowing that like that's the power of a plan, really. Like it gives you that permission to kind of enjoy now and know that the future is kind of taken care of to a certain extent. Now, it wouldn't be a retirement conversation on any given day without someone asking the question, what is the magic retirement number? It's always been a favorite and popular question, and maybe that's how we started the retirement conversation many years ago, which is how much money do you need to have saved? And so people always like to ask the question, how much do you need in retirement? And so I've asked my producer actually to bring up a slide tonight. And it's based on the Massey research of, what does it look like in terms of monthly or sorry, weekly amounts, in terms of, what would it look like per week to have a certain amount of money. So just quickly to explain to everyone, the Massey research basically works out, how much you kind of need on a per week basis to live a no frills retirement. And then they kind of compare that to a choices retirement. And then we've also done an internal comparison to kind of look at like what the average Enable Me clients spending. So someone on a no frills retirement is probably spending, we're going to say circa around $50,000 a year. At the Enable Me end of the spectrum, that's probably closer to $100,000 a year. Um, what I was going to say to both of you, and Karen, let's start with you. Everyone's always after that kind of magic number of what is right. And obviously, there are so many questions because if I live in the city versus live in rural New Zealand, like my number might be different. So Can we just stick to one number? Can we tell all of New Zealand that it's $1 million or no? Okay,
No,
all right,
no, no,
all right.
you
So how do
can't. And I loved it when the Massey University study came out because I had a really good look through it and I thought there is no way that I could live on a no frills retirement because I think it said it was like $5 a week for alcohol and $14 a week for meat. I think that might have been a couple, I can't remember now. And I looked in my freezer and I was like, oh my God, I've got 2 eye-fillet steaks that were $15. That would be it. That would be the only thing I'd be eating and maybe sharing a glass of wine or a beer with my husband. So there's no way I could ever cope with
$5? I
a
think you're
no
drinking
frills
scrumpy,
retirement.
Karen. I think you're
So
drinking scrumpy if it's $5
I
budget,
know,
and that's
I
for the
know.
month. Yeah.
But I think the thing we do when we sit down with clients is we work out what your life costs because everyone's life's different. Mine's Stuart's life, your life color will cost us
Yes.
different amounts, and I think it really depends what you want to do. So yes, where you live can affect how much you spend, but also what you enjoy doing. Like if you enjoy traveling regularly, you might need a bit more money. If you're very sociable and you don't think that you want to give that up when you finish work, it's going to cost more. But what we need to do is understand the actual figures behind what you need. So it is individual to everybody. I don't think there's anyone that really could truly say you need $500,000 a year
Yeah.
or whatever that comes out with. It depends on you and the lifestyle that you want to lead. And some people don't mind living a no frills retirement, but other people like myself would really, really struggle with that. I mean, my husband says I've got a black belt in shopping. I can't see that my money personality is going to change hugely between now and when I retire. So I need to understand how much I need in retirement, and that's what we do with our clients. We work out what they
Yeah.
individually need.
We saw the holiday photos, Karen. I can't see you doing a no frills retirement. But Stuart, like maybe you're at the other end of the spectrum. I don't know. How does it work with your clients? Do you find, how do we get to that number, or do you look at it slightly differently?
Well, we do some projections early on, and so doing it in your 50s is a really good idea. So that's doing projections, looking at what you're doing now and seeing what it's going to look like when you're 65 or when you want to retire. And if that's way out of your scope right now, then if you're in your 50s, you can change that. So that's one of the things you need to do for a start. But yes, most projections really help and giving people an idea long before they retire whether they can what they're going to be looking at, what they're going to be,
Yeah,
where they're going to be traveling,
yeah.
how they're going to be visiting their children overseas and whatnot. So do it early.
And so one of the other questions that has come up is, you know, are you in a lot of trouble if you're in your 50s and you don't own a home? I think the New Zealand kind of philosophy has been built on the idea of home ownership, but going forward, that might not be the case for everyone. And so, Karen, maybe do you want to talk to what does retirement look like? And maybe it's just about those calculations and how we kind of calculate if you don't have a home and what that might look like for your retirement. Obviously, just increased costs potentially.
Yeah, well, if you don't have your own home, hopefully you've invested in other ways because not everyone invests in a home. There's a lot of people that will invest in different assets to give them wealth in retirement. But if you don't have a home or you don't have that wealth built up, it is just really important that you consider the fact that, the rents might go up and things like that. So you just have to sort of have some kind of buffer prepared that the cost of living will go up. Hopefully your KiwiSaver will last. It's all about trying to prepare in other ways to sort of cover those buffers really of increasing rents and things like that.
Yeah.
I mean, if you own your own home, even if you're mortgage free, you've still got your rates going up every year, your insurance is going up. So, yes, it would be lovely to be mortgage free, own your own home, but not everyone's in that situation. But we will all have increasing costs. Unfortunately, when we retire, they don't freeze those costs. They don't kind of say, right, your rates are never going to go up. You're never going to have a rent increase again. It's just going to happen. So you've just got to plan as best you possibly can with what you've got.
So that's a really good kind of point, which we had a lot of questions come through, and just to ask a couple of them. So firstly, if you do want to kind of get onto that property ladder in your 50s, what does it look like in terms of lending? Is that window for getting lending getting Like, is it just as easy to get lending in your 50s as it was when you were younger, or is it getting more challenging? What does that look like?
It's a little bit more challenging, but it's more the fact that the banks don't want you to have a mortgage, when you're 80. So they have
That's fair.
obligations
Yeah.
to make sure that you're not, they're sending you out to work when you're 80
Yeah.
something, to be able to pay the mortgage. So generally, most banks would want you to be mortgage free by the time you turn 70. And if you think about the first home buyers at the moment, average age is 36 of buying your first home,
Yeah.
average mortgage is 30 years. So that's 66. So they're kind of already building that in there.
Yeah.
It might shorten your loan term slightly, but generally not. If you're able to leverage, they don't mind you leveraging to buy investment properties in your 50s because they know that you're going to consistently have a rental income coming through, even
Yeah.
if your full-time employment isn't there once you retire. So
Yeah.
it changes, but it's not undoable. It is totally doable. The
Yeah.
banks are always wanting to lend as much money as they possibly can. We just have to help you get rid of your mortgage as quickly as possible.
Yeah. And so here's a good question as we kind of talk about paying off the mortgage. And I'm going to start with you, Karen, and then we'll kind of move across to you, Stu. But what's the strategy in your 50s? Like if you've got a mortgage still, and it could be high, like do you focus on paying down that mortgage? Do you focus on putting more money into KiwiSaver? Like what's the strategy at that stage?
I suggest to clients if they've got a mortgage and it's a decent sized mortgage, don't put more than your 3% into your KiwiSaver. So get your contributions from your employer. The rest of that money, rather than putting into your KiwiSaver, try to pay it off your mortgage. So really reduce as much fritter as you possibly can. Really focus on understanding what money that you have available to make some good strategic payments off of your mortgage. We want to make sure that you've got buffers so that if something goes wrong, you're not left with no money because you've been paying it
Yeah.
all back to the bank.
Yeah,
So the
exactly.
strategy for setting up your mortgage is really, really important. The reason we say about not putting more than the 3% into KiwiSaver, as I say, it can be quite hard and restrictive to get your money out
It's
if
locked.
something happens. So
Yeah.
even if you have financial hardship or a serious medical condition, they're not going to pay out all your KiwiSaver to you. They may pay you 3 months worth of your bills, which you have to prove what you've got. So
Yeah.
saving outside of KiwiSaver is better than putting a lot more into it that you can't get at when you really need it. So
Yeah.
Stuart would be more of an expert, I would imagine, on other
Yeah.
options other than
Yeah.
KiwiSaver. But
And
yeah, totally try to get rid of your mortgage as quickly as possible. Yeah, focus on what's left over in your pocket every week and really just nail that mortgage as quickly as you can.
so if you have got savings sat in the bank, and when we hear that and people say, I've got money sat in the bank, and we all go,
No, no, don't. No.
yeah,
Um, if
yeah,
you've got a mortgage and you've got money sitting in a bank account, you're being really inefficient with your
yeah,
interest. So
yeah,
if you think about the banks paying you maybe 1 or 2%, then by the time you get taxed and you've got inflation, that money's just gone backwards. But if you pay it off your mortgage, you're instantly saving the interest rate on
yeah.
your mortgage. So
Correct.
the
Correct.
important thing is that if you pay it off, you do need to be able to draw it back in a way of a buffer. And often that might be a revolving credit facility or an offset or something like that. But you need the ability to draw back just in case you need to. Because if you lose your job or you have something go
Yeah,
wrong, the bank's not going to say, yeah, we'll lend that money back to you
yeah.
because they're like,
Oh,
yep,
yeah,
thanks, we paid it back. That's reduced our risk.
yeah.
We're all good, good luck.
But Stuart, if someone has got money in the bank or a term deposit, say they're in a position where their mortgage is, in the final stages, and they're starting to, and we do see this where people are starting to accumulate money in term deposits, etc., and the term deposit market's starting to change, Stuart. What are the options? Like, should you put more money into KiwiSaver, or is that time to start looking at other investment strategies for that money? What are the benefits?
Yeah, definitely. We're getting a lot of people coming into us now with, matured term deposits and looking at the reinvestment rates and thinking there must be better options out there. My KiwiSaver's doing pretty well. What should I do? And you're right. If you're sort of 4 or 5 years away from drawing on your KiwiSaver or having access to it, there are other options. And one of the things you do when you or we start doing as financial advisors is start doing a decumulation plan. So initially, your first 5 years of drawing on that plan will be in low risk assets. So what you could start doing is building up assets into low risk funds that are not in KiwiSaver, maybe just a conservative fund outside of KiwiSaver. So when you get to the age you want to retire, then that's already set up for you to start drawing off
Nice.
it.
Yeah. And there is sometimes where people get to retirement age and they think best thing to do is to cash in that KiwiSaver and kind of move it to a term deposit. Thoughts
No,
there,
definitely
Stuart?
not. Definitely
Yeah.
not. That's not the best thing to do. Yeah, no, I mean, they've got a long time probably in retirement as well, 20 years plus, hopefully longer. And so therefore, their time frame for investment, they can take a little bit more risk with that instead
Yeah.
of living in. You always need that sort of buffer, as we've talked about already. But
Yeah.
yeah.
And so KiwiSaver funds can kind of be growth, they can be balanced. There's a whole variety. There's aggressive. Obviously, your strategy is going to change as you get closer to retirement potentially. But but what's the best thing to do in terms of deciding what that strategy should be? Because I think we start to perhaps make decisions that, as you said, like we could still have a 25-year time frame left, and the tendency could be like, I've hit retirement, put everything into most conservative fund possible. But what is the best strategy there? What's the benefits
Um,
of talking to somebody?
well, what you can do with KiwiSaver is you can have more than one fund. And most
Ah,
providers means you can have a balanced fund, then you can have conservative and even a growth fund. So
you can split
as
it
you,
up.
yeah, and so therefore you start drawing off your conservative fund, and each year you sort of move a little bit to your conservative fund from the balanced fund and so on, from the growth fund to the balanced fund. So there's lots of options in KiwiSaver these days. And if that's your preferred way to fund your retirement, then that's an option. Have more than one fund.
And your KiwiSaver, like if you want to use managed funds, it doesn't have to be the same as your KiwiSaver provider. You can mix and match, and sometimes the advantage of independent advisors like yourself is you're going to look at a whole variety of KiwiSaver funds and you're going to look at a whole variety of managed funds and you're going to kind of sort of pick and choose.
Yeah, you can spread the risk. And what I mean by spread the risk is you spread the manager risk. So the fund manager, there's lots of
Right.
different fund managers. They all take different approaches. So you might want to take two different approaches with two different fund managers, as well as your KiwiSaver. So there's plenty of options out there.
Don't
And
have to put it
that's
all on black.
no, you don't. And you got to talk to someone about that, and they'll give you, financial advisors give you options about that.
And so in that mix, we've obviously talked a lot about managed funds, which becomes a really like popular, sort of more popular as you go into your 50s. There's still a lot of people who've still got investment properties at that stage. And Karen, they're starting to kind of think about, well, what do I do with the mortgages on those investment properties? But one of the things is that there starts to be that consideration like, well, do I use my investment property as a passive income or do I start to move it on and actually liquidate it? What are some of the considerations you should kind of have around whether you hold it or fold it with an investment property? Like, how do you know when it's time to move that investment property on?
What I look at is, the returns and the yields on the investment properties, because if our property has gone up in value, if we've had some capital growth, but our rent's still not particularly high, you might think, well, is it better to be actually invested in something like a managed fund where there might be better returns, or you can get a more steady income at a higher rate? And that might be sitting down with like someone like Stuart and saying, well, at the moment, if my rental property is worth $1 million, I'm getting $500 a week rent, but it's really not enough. That level of investment is not giving me enough money to live off. So Stuart would make a plan for somebody to say, well, okay, well, how much do you want to draw? And you've got that more flexibility about how much you can get. You can't go to your tenants and go, well, you're actually not paying me enough. So rather than $500 a week, I need about $1,000 to live off. So, stump up with some extra money. So you
Yeah.
can't do that. So you've actually got to really think about that value of that asset, and is it giving you what you need? So how much do you actually need that investment to earn and to give to you? And sometimes it may be drawing some of the capital out if
Yeah.
you need that in retirement. So it could also be that the investment property is getting a bit old and you need to do a bit of work on it. And it might be a matter of if it's gone up in value, you might want to replace it with a cheaper brand new property, and invest some more money with a wealth manager like Stuart, so you get that diversification with your investments as well. But there's a few factors to take into consideration there.
And that's also, sometimes we get to a certain age. I feel like I'm getting there already, people, where I'm just like, I can't be bothered with
You've
the
just had one of
hassle.
those days today,
I
Carla.
have had one of those, well, actually, like where with my investment property, someone said, "Can I have a kitten?" And I was like, there's all those things that start to come into play.
Yeah.
And so I guess that's another factor. But the advantages is that, like, I guess with a good plan, you will kind of draw in all of that expertise, like that property expertise that like we're still in accumulation phase, to be really clear, in the 50s, but it's like that accumulation and then starting to prepare for what that decumulation phase will look like. And I think that this is a nice place. I'm aware that we've kind of slightly overrun over time, but we've had so many great questions. But this is a nice one to kind of start to round us off, because in the 50s, probably the area of, we'll call it decumulation or asset drain, tends to start to be your children.
Yeah,
We're seeing
absolutely.
an increasing amount of decumulation going towards helping the next generation. So there's a lot of people in their 50s that are starting to think about how do they help their children get onto the property ladder? How do they help finance their grandchildren to go through university? I think we're seeing an increasing amount of that. Like, I kind of say there's two sides to this wealth equation. People are kind of building wealth for all of their retirement to make sure they're okay, but there are some people who are out there kind of thinking about their wealth journey and about how they can kind of help people going forward. And that's very true. Someone's just kind of said the same thing, which is that the asset drain is helping my parents. So there's a lot of people who are sandwiched, and there are a lot of people who are actually supporting elderly parents as well, because there have been people who've been caught out with the cost care, etc. So we acknowledge that as well. But what is the importance of kind of sitting down and having that plan? Because we see parents underwriting their children's mortgages. We see parents kind of gifting $50,000 to buy cars and things like that. Karen, you can probably talk to that, and then Stuart, I'll come to you. But why is it really important to kind of build that into your overarching plan?
The thing is, if you want to help your kids, and I'll just talk about your kids because we do want our kids to do well, but not at the sacrifice of our retirement. I think that's really important. So there are other things that you can do rather than giving your children your money. Because I know with my daughter, if I loan my daughter money, I probably will never ever see it again. She's only 21. I always transfer money and it says loan, and whether or not I'll ever see it, probably
Amen,
not.
sister.
And yeah. So I think you can do things like you can do offset mortgages. So like your
Yeah.
children can have a loan or a mortgage with some of the banks. You have money that stays in your name. You don't earn any interest on it. So it is, like you are sacrificing something because you're not earning an income off of it, but that money's always available for you whenever you want to take it out. But your children benefit with paying no interest on that part of their mortgage, the money that's offset against your savings that you've allocated for that. But the minute you want to take that money off, that's fine. You go off and go on holiday, whatever you want, and then suddenly they start paying interest again. So offsets are quite a good way of doing it because you're
Okay.
not really giving it to them, but you're giving them the benefit of not paying interest on it. So
Yeah.
that's a great way of helping them with mortgages and things like that.
Another thing is having these conversations, and we're seeing an increasing amount of people actually, the education piece is really important too, isn't it, Karen? Like actually kind of bringing your children in on these conversations. So we're getting more intergenerational, like setting your children up with the right mortgage structures and those sorts of things. That is actually some of the best investments you can do, like the right habits, the right behaviors. I both of my children are well, one's just turned 18, but you know, my 14-year-old is in KiwiSaver. She's like, I don't know why I'm in KiwiSaver. And I'm like, you will start saving for your retirement now. And that education piece is probably one of the greatest assets we can give our kids as well at the same time.
It is, and Carla, the thing is, it's really hard. Like when you do finances yourself, that often your children don't want to listen to you at a certain stage, but then suddenly the light turns on and they understand it. So, you know, we lead by example, and a lot of my clients will say to me, you know, I didn't have a great role model with my parents, so try to be the best role model you can be for your children, and then teach them what you know. Teach them the really good habits of how to manage your money, and then hopefully that will go through later on. But yeah, the better life you give them now, when they leave home, they're not going to have it. You're setting that bar really, really high. So, you know, you've got to be really careful of that as well. Or they won't want to leave home.
I know. And Stuart, I think you just had a child come in. And so that's okay. Yeah. It's a great webinar when you've got a child that comes in. But obviously you deal with a lot of people who deal with gifting and all of that kind of thing through that wealth management journey. So what's some of the things you do with parents in that process?
Well, I say what you've already said before is make sure you don't leave yourself short as well. But a lot of parents are doing it, you know, whether it be 30,000 or 100,000 in some cases, they're helping them into the first home. And then, you know, at some stage, you know, the children are usually they've got jobs, good jobs, and so eventually they start hacking into it, the mortgage. But also, you know, one day they'll maybe inherit some assets, a house, so they don't have to have everything perfect right now. They've got a long life to live, and people in retirement haven't. So,
well, that's been a fantastic conversation. Always love doing panels. Karen, Stuart, thank you for your time. I'm going to let Karen close out because obviously we've talked a lot tonight, but there's a huge amount of benefits in terms of coming to talk to one of our advisors. So Karen, over to you if anyone wants to come and catch up with us, and they can come and see any of our advisors, but also if they want to come and kind of meet with a coach as a starting point.
Absolutely. So I think, Jess, we might have a QR code to display, but sitting down with a financial advisor, wealth manager is, you know, it's just an amazing investment for your financial future. So if you haven't done it already, it's really important to sit down, have a chat to us. We can really help you during our financial consultation. It's 90 minutes about chatting about you and your finances, your goals. We can give you some tips and tricks about how to do things, and then hopefully we're going to be able to help you with a great plan leading towards your retirement. So tonight, because you've sat with us and listened to us, and hopefully you've got a lot of good ideas from what we've talked about. So thanks, Stuart and Carla, for that. Tonight, if you join if you take a photograph of the scan, the QR code there, your financial consultation will be $100. There's a special offer, it's normally $400. If you make the booking after tonight, it's $149, but I tell you, it's money really well spent. We've got the most amazing wealth managers. We've got the most amazing coaches that enable me that are really wanting to sit to help you achieve your financial goals and having that dream retirement. So thank you, guys.
Yeah, thanks everyone. Evening. Yeah, it was really fun. Always learn a bit along the way. So thanks everyone for their time, and we look forward to catching up with you all soon. See you later.
Thanks all.
Bye.
Bye.